Well, good morning, everybody. Thanks for coming to the session. I'm Will. I work on our corporate sales team here at the AFP. Just before we get started, you guys know the drill. Just a few things, got to review. Bear with me. Just wanted to highlight a new feature we're doing during the attendee lunch this year. We're having table topics. It's a great way to kind of network with people at the attendee lunch. There's a list of the topics at the attendee lunch area. You can kind of select which one looks good and pick out a table that looks interesting. And then later on today, be sure to go to Fareed Zakaria, our Tuesday keynote, for his session on how to navigate global forces of disruption. But now for our session, Money-Saving Developments Hedging with New Financial Instruments at CME Group, featuring John Coleman from RJ O'Brien and Jeffrey Sharp from Eris Innovations.
Thank you, everybody. Good morning. Thanks to AFP for having us join you today. Jeff Sharp, who's with me, just to give a really brief background. Jeff spent most of his career on the over-the-counter swap trading side of the business in U.S. dollar swaps and swaptions. He transitioned about 4 years ago from the OTC side of the business to the exchange-cleared and traded futures side of the business. And we'll get into a couple of those reasons later, but primarily due to economics. I myself, John Coleman, I am with an FCM, RJ O'Brien. There's no infomercial here. There are 50 FCMs in the U.S., and I guess the reason that brings me here is I represent our clients, which are the end user side of these Eris CME swap futures. Today we just put some magnitude on it. We have about $10 billion in notional on the 10-year and significantly more elsewhere on the yield curve, so something like a $10 million DVO1 right there. So I'm going to start right off and try to get through the front of this. Excuse me. Let's see if we get that. Great. So a little bit on the history. Of course, most people, first, who in here, whose company is involved in the interest rate swap market today, in the bilateral market? Great. And how many of you use over-the-counter cleared swaps or self-executed and OTC cleared? And I'm going to guess that that means the number of you that are using swap futures today is probably small to zero. So hopefully we have some information that I think will be of value for you. But the history, of course, going back pre-crisis, was in the bilateral market. All the costs and liquidity were largely hidden from the end user. When you would call a dealer or a number of dealers, you say, I need a fixed payer for X number of amount or DVO1. And everyone say, I can call 3 or 4 dealers and I get a number that's within a quarter of a basis point, so this must be a great market. Of course, the bilateral market is one-sided. They know which way you're going, they know how many you want to do, and they know who you are. And there is absolutely different pricing structures for different types of end users. One of the things that kind of held even post-crisis and post-Dodd-Frank with the if it can be cleared, it must be cleared mandate was accounting and systems. People are definitely tethered very tightly to their accounting. They're also certainly not going to rip out systems to try to come up with a new way to handle projects. And I guess the final part of that was really also coming out of Dodd-Frank. We had an increase in transparency of costs. Some of it was obvious, where we just simply see a slightly different bid ask, or we receive a ticket that tells us from how far from mid we may have traded this particular swap. And then there were the legal and compliance costs that also went up. So one of the things, several things came out of Dodd-Frank. One was we went from solely a bilateral swap market to really a 3-silo swap market. There was the legacy bilateral and ongoing bilateral transactions. There was this OTC cleared silo and self-executed transactions. And then there were swap futures. And I'm gonna move this along here. And this is really, I guess, why we're here today. From 2013 to 2017, that was a period where the users of a swap future really looked like bulk risk traders. So you could say, oh, it might be a hedge fund, it might be a REIT, it might be somebody hedging a very large generic risk. And in August of 2017, when FASB came in and definitely lightened up on accounting mandates in terms of ex-ante documentation, pre-trade testing, and went to more of an immateriality type approach. If we don't have our dates exactly lined up, and it means that on this $1 billion position, we might only have an inconsistency of 20 grand. Well, finally, they said that obviously is immaterial. So what we saw in the early transition with swap futures was subsequent to that, the FAS change, we picked up a good number of users, and volumes increased significantly on the futures side. Then in December 2018, the CME bought what was the Eris future and brought it into their portfolio of businesses. The Eris future at that point, Jeff, was about probably a 30 to 50% surge in volume, depending on where you were.
No, five-fold increase in volume.
Fivefold. All right, go ahead. So the point is that the one, first part was accounting accessibility, and really the second part was that CME imprimatur, because there are so many end users, of course, that have used Treasury futures and S&P futures for different purposes. But when we look at what swap futures have brought to us, it's simplicity and it's economics. Those are the two things that whenever somebody says, well, why would anybody go and use a swap future? And the answer is, for hedge funds, maybe it's, oh, we're anonymous. And people say, oh, well, we don't care if we're anonymous. Everybody should care if they're anonymous, because depending on who you are, if you call up as BlackRock and ask for a level, it's a lot different than if you call up as XYZ and ask for a swap level. So part of this was the idea that, futures, you're anonymous. You have a standardized contract. What does that mean? Well, it means operational simplicity, and this is a big part of it. When we trade in the bilateral and the over-the-counter cleared market, you have 4 line items that you have to contend with. You have a accrual for pay, an accrual for receive, you have a net present value, and you have a PAI. When you trade a futures contract, all those cash flows are molded into one price. So whether we continue on from a forward starter past the effective date, you end up with all those historical cash flows bundled into the price of the future. So from an operational simplicity standpoint, we don't have cash flow over here, cash flow over there, an NPV here, and a PAI adjustment. It's all simply one price. And that, I think, was a huge part of it that ultimately brought us here. So I'm going to let Jeff go on, who has the more of the guts of it, and I'll rejoin you guys at the end of this.
Okay. I'm going to stand up and illustrate a few things here. So firstly, if we think about what a swap is, and then we're going to illustrate how the contract replicates that and how you're going to use the contract. And I'm going to do this several different ways, but ultimately they should boil down to the same thing, and you should begin to see the simplicity of it. So what is a swap? A swap is a series of future cash flows. Let's imagine we've got a great big jug full of juice, and that is the future cash flows of that swap. Over time, the value of that jug can go up and down. That's the mark-to-market of the swap. And then we pour some of that juice out into these fixed payment and floating payment ledgers. That's the cash flows of the jug. At the end of the swap, there's no NPV of future cash flows. It's all a cash flow in the glasses of fixed and floating payments. That's a swap. Now, if we put all of that in one package, okay, and index that to an instrument that trades on an exchange, we now can get all of the benefits of an exchange-traded product, yet all of the cash flows of a swap with the ledgers, the NPV of future cash flows and the fixed and floating payments, in exchange databases. So now to some extent, you're handing the management of the accounting side of things off to the exchange, and you just pull the exchange values, and those are your reported cash flows. Because you own the contract or you're short the contract, and that will reconcile with the explanatories of the contract itself. So let's use an example where you have you've borrowed some money on a floating rate basis, and you want to hedge it for, say, 5 years, right? So you're on the hook with your lending institution to pay them a floating rate. We'll just assume it's 3-month LIBOR for now. Obviously, that will change in the future. And you want to now swap that for 5-year fixed term. So what you're going to do is you're going to sell your desired tenor Eris swap futures contract. And in selling that contract, you're short a position which has embedded cash flows of pay fixed, receive float. And those swap coupons settle through the Eris price. And the accounting treatment you're going to get is the same as the accounting treatment that you receive today. Obviously, developments in FASB's ASC 815 makes that a lot easier today, given that you don't have to keep track of the ineffectiveness. So recent changes have helped the process, but now you're going to use a simple, transparent instrument to hedge your debt issuance. So let's look at it another way again, all right? You're the corporate treasury, you've borrowed some money, you're paying LIBOR, you want to switch that LIBOR into fixed. So if you think of my juice in the glass, juice in the jug analogy, these cash flows are juice as it flows into the glass, out of the jug, okay? Now there is an additional cash flow in the wholesale swap market, and that is price alignment interest, which is interest on collateral. The person who's posting collateral receives interest. This is price alignment interest. So now we have these 4 different ledgers. The juice in the jug, which is the mark-to-market, the swap NPV, the juice in the glass, which is your fixed and floating payments, and then the price alignment interest. In the case of a swap future, we put it in a wrapper. Everything in one accounting, one single unit of account, okay? And then disclose each individual component. You're not managing a ledger in your banking systems for the mark-to-market and the cash flows. It's just one futures account through which all of your cash flows are settling. And then in your reporting systems, you're reporting the current income, right? Your core income, if you want to call it that, taxable in the current year, and you're reporting the changes in the mark-to-market, i.e. in lieu of future cash flows. So this is reported in the Eris price daily as A, the swap NPV, B, the past cash flows, the juice as it pours out of the jug into the glass, and then price alignment interest. Okay? Now, when it comes to reporting, it's important to understand the exchange values so that you can then retrieve the exchange data and report your quarterly earnings and other comprehensive income, right? This data is available daily, published by the exchange, and it reconciles with the position you have in your futures account. So there's automatic reconciliation from that process. If it doesn't reconcile, then there's an error in the math, all right? So I want to look at it another way. This is the 3rd time we're going to go through this to some extent, and I apologize for that, but the key here is to recognize the simplicity of this instrument and how you can then use it to save yourself time and money. So if we go back to the swap, this is a representation of the fixed cash flows, okay? Effective date to final maturity date. And you're going to be paying this and receiving floating that you're then going to use to hedge out your borrowing. This is a representation of the variable cash flows. What I'm going to illustrate here now is the exchange disclosures, CME's disclosures of the values that you then use for your reporting, accounting and tax purposes. So on any valuation date, whether it be before or after cash flows have started accruing, and one of the key things to understand about the Eris swap futures contract is it actually resides as a listed futures contract for its entire life. So the whole terminology future, this doesn't settle into anything in the future. this actually is a swap in listed futures by name form. So at any point in time throughout the life of the contract, right, this value date could be your first reporting date. So on your first reporting date, you're reporting how much income you've earned or your expense versus what's the change in your mark-to-market. So you're going to use exchange values. Well, if we bifurcate exchange values, the swap has an NPV on this value date that includes cash flows in the past that have not yet settled, because this fixed cash flow is going to pay on that date. You've already had one floating cash flow settle and a little bit of floating cash flow that is yet to settle in the future. But the NPV of a swap is the present value of cash flows that have not yet poured out of the jug into the glass. The past cash flows have poured out of the jug, and they've ended up in the past cash flow ledger. So that's only part of the equation, because of course when you're reporting, you want to report everything up to the value date. So the exchange also discloses and reports back on a daily basis the realized coupons and accruals, i.e. everything left of the value date, and the unrealized mark-to-market. So now if you think of value date 1 and some value date again in the future, then what's realized in your reporting period is just the changes in these values. And it's nothing more than pouring water into the glass, and your income during a period is how much water ended up in the glass. So you think of these values left of the value date as essentially have taken place, or they have been realized, and the values to the right of the value date are yet to be realized. So now you have your unrealized gain or loss from changes in value of the swap, which is your other comprehensive income, and then you have your accrued values, which is income in the reporting period. And this, of course, will all come out in the wash with reporting GAAP income, but for tax purposes, if you are bifurcating the two, then it's important to realize that, or appreciate that this information is available. Moving on. So when it comes to the practical application, you're going to find that the hedge designation process is actually similar to any swap, because what you're doing is you're designating it as an eligible hedge. And we're going to touch on that in a second. You're going to find that the contract cash flows are actually exactly the same as the equivalent swap, because whatever swap is embedded in this futures contract is exactly the same cash flows that are taking place in a physical contractual swap transaction. Because of that, the hedge effectiveness is going to be exactly the same. Now, when it comes to you using your customized swap, what you're going to find is that the performance of this standardized instrument is indeed pretty similar. And I have some regression analysis to show you. So what we've got here is we ran 3 years worth of data of a swap futures contract against the 3 years worth of data of a customized swap with different dates, different coupons. And look at this, the dirty secret of the swap market. If I do a swap today for 5 years, it performs almost identically to a swap I did 6 weeks ago with a different coupon. Why? Because these are funded instruments valued on the same yield curve. And having been a swap trader for much of my career, we like to keep this secret, but that's the data. The other thing is this data has never really been easily available, because the value of a swap is just the value of future cash flows. So when you want to look at the data, how do you aggregate it with everything that's past to run a total return analysis? Well, because the Eris contract combines all of the cash flows, we now have a framework that you can apply to creating total return swap indices to run this historical regression. Now you're going to say, well, what about P&L tracking? Historical regression is just telling me price performance over time, which looks pretty good. R-squareds of 1, betas of 103. P&L tracking, no difference. You're looking at the red line is your swap futures contract, standard instrument. The green line, which is behind it, almost identical. is the customized position, and looks like 6 weeks, about a month difference. So there is negligible difference between doing a standardized instrument, which, by the way, you're not determining price transparency. Everyone else in the market is. You are not the only one in this transaction. Everyone else is in the transaction. So a couple other considerations which, we can address down the road, and I would encourage you to explore these products, is you want to take a look at some white papers that have been created on applying these contracts for cash flow and fair value hedge accounting, right? You're going to have tax questions. Futures are, by default, treated as capital gains instruments, meaning that the profit and loss from a futures position is treated as capital gains every year, 60% applied long-term, 40% applied short-term. But there are exemptions, and the exemptions are exactly what we're talking about here if they're being applied for hedging purposes, hedging of financing, the example used here. The other thing that is important to appreciate is because this is a listed contract on an exchange, there's now mandated margin posting, something that many of you may not do today, and obviously concerned about the operational exposure or cost of managing margin posting. Well, in a post-Dodd-Frank world, I have news for you. Whether you do it or not, you're paying for it. And if you are doing it through a CVA, you're going to pay far more than you would pay through a more transparent process, either doing it yourself or independent margin administration companies have started to set up, and they are fit for purpose today. So I'm going to hand it back to John as the practitioner of executing these transactions. But hopefully this gives you some context of the simplicity and the efficacy of the product.
And I think I'm going to just tail off on your comment about margining. So one of the reasons that we see the transaction volumes that we do, if we take a 10-year receiver or fixed payer swap that is cleared in the over-the-counter silo, and we compare that to a future that is cleared at the same central clearing party, the CME, in this particular example, the difference in initial margin requirement today is half, meaning the person that executes these hedges in an all-to-all market at the 10-year level is literally required to post half the collateral for the identical swap that is cleared through the over-the-counter silo at the same exchange. And that was a big piece of what came out of Dodd-Frank. And like I began with those three different silos, this idea that if Dodd-Frank, what they should have said, if it can be cleared as a future, it should be cleared as a future. If it can't be cleared as a future, but an exchange can value it, it should be cleared as an over-the-counter cleared swap. And if it's simply something that has a credit component or something esoteric that the exchanges aren't comfortable valuing, then it should remain in the bilateral silo. That was not how it was phrased. Instead, they tiered the margining so that something that is cleared as a futures transaction is cleared at a 2-day historical VAR margin. Something identical in the over-the-counter silo, cleared over-the-counter silo, is at 5-day historical VAR, and for that in the bilateral market, 10-day HVAR. And as Jeff said, the invisibility of cost in the bilateral market makes people oftentimes feel better about the transaction. Oh, I did this for free. And rest assured, there is no free. If somebody else has to post 10-day HVAR against the swap that you gave them, they will take it out of you in bid ask, and nobody misses by rounding down. So without beating it too far, the point here is you can look when we hit periods of higher volatility like we saw this summer. There were times where we approached in the 5-year sector where the identical swap cleared versus future, it was literally 4 times the amount of collateral to hold that same position. So for people that run a company and pay a dividend or try to improve their rates of return, the idea of holding 4x or even 2x the amount of basically dead capital to satisfy the risk side of this, it's brutal. And we've seen a lot of problems today in short-term money certainly over the course of last month, where there simply is collateral is absorbing a lot more than most people are comfortable with in terms of holding margin dollars. So as you try to evaluate why would I ever want to do this, as we move and we transition, as the market transitions potentially to a different benchmark, whether it be SOFR, OIS, or whomever tells us whatever it's going to be, these futures will transition along with the cleared swap market. In as much as that happens, it presents a system simplicity because if one day my LIBOR-based swap is forced to convert to a SOFR-based swap, well, that simply will just happen in the case of a futures transaction. In the case of a bilateral transaction, all this stuff has to be negotiated. The fuse is burning. This morning, the CME came out with a post saying that originally they were going to throw the conversion switch July 17th of next summer. People have heard, oh wait, banks are going to continue to post LIBOR up until January 1st of 2022 and maybe even beyond, and that is true. However, the derivatives are going to convert long before that. So the magic date, both LCH and CME at this point have said October of next year is when the switch gets thrown. And now I'm going to move a little bit. I'm going to back up just for 1 second in terms of how do you trade these things? The answer is for those. First of all, anybody can trade a future. A future is as easy as trading a stock on an electronic platform. You do have to. It's different in that, as I said, there are 51 FCMs that are out there that clear futures, any one of them. So if you have any type of an involvement with a treasury future or with a LIBOR-based future or with an S&P or anything like that already, you probably have a system already installed that can handle what goes on here. And as far as how hard is it to set up, setting up a futures account with an FCM is no more difficult than it is to open a margin equity account. So from a retail perspective or institutional, it's just simply this has been the futures business has been regulated since they were trading grain on the LaSalle Street back at the end of the 1800s. So the good news is that anybody that wants to participate, you can get there. How do you what if I want to buy or sell, or I want to fix or float? The answer is this market exists as a voice market and as an electronic market. So when you look at an Eris swap future, you see a yield for the bid and you see a yield for the ask. There's no question as to where I can execute this trade. Not just where can I put on a fixed payer, but what if I want to see how wide, how much am I giving up to the market? That's no different again than watching a stock trade. In futures like stock, if you execute a transaction, there's no renege. People don't disappear on you. It's a regulated transaction from the onset. The ease of it, the ease of execution, for those that when you're in more of a corporate treasurer or CFO role, most of those transactions are still executed by voice, although we do have quite a few that come through Bloomberg. Bloomberg has a futures execution platform built into it as an illustration. I think I don't want to go too far or too much further than where I am right now, but the answer is you don't need to talk to me. You don't need to talk to Jeff. If you have a broker that you deal with, there is a good chance that they have an FCM. If they have an FCM, these transactions are available to you. They're available without an ISDA, without a CVA, because all these trades are routed. The central counterparty for both the buyer and the seller, the long and the short, is the exchange. And by putting the exchange in the middle of this, one of the reasons the margins are lower is precisely that. We no longer have any credit component. So the trade-off is, yes, I have to put down a margin. Yes, I make and take two-way margins every business day. But in regards for that, I know that I have a completely visible, transparent, and completely anonymous method for executing these transactions. So, Jeff, I'm gonna push back to you.
So to wrap it up, and we'll take a few questions as you have. The key takeaways here are really very simple. Cost increases way of life in a Basel III, post-Dodd-Frank world, post-global financial crisis. And there are now exchange-traded instruments available that are easily accessible without cumbersome onboarding documentation. Futures are traded incredibly easily by anyone. You can trade them yourself for your own account to the extent you want. You cannot do that with swaps. And as a result of all of this, there's transparency, cost savings that are easily accessible to everyone. And then, of course, the Eris contracts uniquely, and I never mentioned this, they are patented and therefore, protected by intellectual property. They're the only futures contract that actually remain as listed futures during their life, replicating the mechanics of a traditional OTC swap. And that's crucial because then they provide the practical application of eligible designation as hedges, creating a marketplace in which everybody can participate, from risk transfer players to banks to long-term hedges, all playing in the same sandbox. So with that, if you're looking for further information, I've provided some contact details here. And as John said, you don't need to speak to us. You can speak to your bank or your brokers to learn more. And if they don't, then I would have them contact us. And with that, I'd like to open it up to a few questions to the extent there are any. All right, well, I will kick things off with a couple typical questions we get. And then maybe that will prompt you to think of your own questions. And John, maybe you could answer these. But a common question is, how much money can I save? Where are these cost savings coming from, and how much is it? Just a sort of quick.
Sure. There are two sides of it. If you're involved in the bilateral market, the savings is entirely contingent on who you are and the frequency that you trade, and quite frankly, the rate of return that your dealer is making off of you in the positions that they've put on previously. When most people come and say, John, where's the money on this? The money for me is simply taking a look at the collateral savings. If I can't estimate who gets a great bid-ask market and who doesn't, but I can tell you that if I sit down and I say you have to post half the collateral to get a fully transparent bid-ask in an all-to-all market, that's number one. When somebody says, give me a hard number. Is it 1%? Is it 2%? And the difficulty is that when you're involved with an over-the-counter swap, a cleared swap, every single day that margin changes. It depends on historical VAR. Futures margins are less volatile, and so what we end up with is we'll have periods, like I said, with a 5-year that might be 4 times the amount of collateral required versus 1 unit in futures, and then we'll have periods where that number may look more like 2.5 or 3. In the case of a 10-year, it might only be 2x. But I guess the the saving side of it always for me is going to be collateral. Normally, we can take, if we wanted, someone wanted to try to figure out exactly what their costs are. The good news is with the swap data repository, oftentimes if you execute a trade and you know when it was done, we can walk in and pull the open market levels and tell you exactly how much was built in. Depending on your familiarity with your dealer, you may get that. It's rare that somebody's excited to say exactly what it costs on the front end, and that's one of the large issues that when you execute directly, you're asking someone to present value all of their costs, and if you were to swap a 30 or a 40-year deal with them, my gosh, that is a whole lot of cost. So I'm not suggesting that a dealer is doing anything wrong in this regard. They want their rate of return, and they have to make sure that their economics are covered. And the longer the tenor of the hedge, the larger that number becomes. And then they have the credit component in.
Yeah, and then, I guess to quantify it in dollars and cents, on a 5-year, that could be between 1% to 2% of the notional for, the less frequent clients to the very frequent users of the swap market. You're talking probably more in the region of 25 to 50 basis points of the notional of the transaction. Any questions? So another typical question we get asked is, what's the liquidity in the instruments like? What can I execute? The way I answer this is very simply. Because it is the exact replica of the cash flows that take place in the OTC equivalent swap, the liquidity is as much as there is demand for the product. And the largest customer trades we've seen, based upon disclosed information, or the largest trades we've seen based upon disclosed information, is what appears to be more in the region of billion-dollar client orders in the 10-year sector, which is obviously pretty substantial. And in terms of observed bid-ask, we've of course can track this because it's public information on an electronic screen. The average bid-ask of the 2-year contract is about 0.3 basis point. That remains constant out to about the 5-year point. So it's about 2 to 0.3 basis point out to 5 years. And then beyond 5 years, when you get to 7s and 10s, it tends to be more about 0.4 basis point wide. And then you get beyond that, and you're talking 0.5 to 0.6 wide on maybe a 30-year, which, relative to, and by the way, this is true liquidity as opposed to you call up and you're told you're paying mid, but you've already disclosed who you are and they already know what you're doing. Another common question that we get asked is, pointers in the direction of tax and accounting. The key clause here is Section 1256 exemptions to exempt the transactions from, typical trader usage of the contract. So if you're going to use it for corporate taxation and accounting, then you want to exempt it from the default futures treatment. If there are no further questions, then thank you very much for attending today.
Thanks, everybody, for coming out.